Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Madison Mills alongside Josh Schaefer, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There's a general skepticism from people that prices can go to $100. I think the types of clients that we're seeing buying the upside options are more or less buying insurance policies.
What was compelling within the JOLTS data is the fact that the quit rate continues to move notably lower. And that is usually a really great sign of confidence or lack thereof for the labor backdrop. And then the other thing is the hiring rate within the JOLTS report. That is now back to where we were during the jobless recovery post-GFC.
The uncertainty centers around, the port strike, which we hope, doesn't last too long. The war in the Middle East, the fact that the lower end consumer is probably a little bit more strained, resilient overall, but still a little bit more strained. And so, what we are seeing is brands and consumers are responding to real good innovation and product pipeline.
And we've got 1 hour to go until the market close. Let's take a look at the major averages. You can see just a sea of tomato soup here. You've got the Nasdaq down about 0.3%, the S&P down about 0.4%. And I know, Josh, you're taking a look at what we're seeing in terms of moves in the oil market, really putting pressure on those major averages.
Yeah, oil futures ticking up again today as tensions in the Middle East continue to escalate. That's been something we've been watching all week. If we zoom out to a 4-day here, of course, since Iran launched those missiles, we've seen a large pickup in oil futures, Maddie, and it's been interesting to just sort of watch this reaction. As you said, this goes up, stocks have gone down a little bit. We haven't seen a major drawdown in the averages over the week, I would point out, but as oil has gone up and those tensions have risen, certainly some volatility has entered the market. I think you've probably seen that a little bit with the VIX this week, and seeing that pick back up, of course, headed into that crucial jobs report tomorrow. It's been something to note going into tomorrow, which I think will probably be maybe the biggest market day of the week.
Absolutely, and you can see exactly what you pointed out here, the VIX popping up 13% over the last 4 days here. I want to broaden out just a bit more. You can see that we are actually taking some volatility out of the picture here, but it's interesting seeing traders kind of positioning against any potential downside move.
And I want to take a look at the VIX overall too and zoom out a little bit, because what's been interesting is, yes, we're picking up, but remember where we came from, right? You go back to a 3-month here, that spike that we got in August, we are not anywhere near that. Of course, that was an abnormal volatility spike, but to see volatility come up a little bit above 20, usually 19 or 20 is when people start talking about the VIX. So the question is, do we pick up more from here? Or are we staying a little bit subdued? I think that's going to be something to watch again post that jobs report tomorrow. Perhaps if it comes in weaker than expected, maybe we'll see another spike within the VIX.
Absolutely. All eyes on that jobs report heading into tomorrow. The last thing I'll mention here, we've got a little bit of a risk-off sentiment happening in the market here. If you take a look at the dollar, you can see some gains over the last day here, just as we're starting to see a little bit of potentially that rotation, a little bit of a risk-off sentiment in the market. You've got tech stocks under pressure, and you've got something like the dollar moving to the upside here.
All right, Maddie, risk-off sentiment. We've got the perfect guest to talk about it. For more on the latest market moves, we want to welcome in Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer. Jeremy, I was just talking about this a little bit, but we've had a lot of headlines this week when you think about conflict in the Middle East, our hurricane crushed the southeast of America, and then you think about the port strike. I'm curious what you make of all these rising risks, and we haven't seen a big drawdown in the indexes. How do you sort of reason with how the market's been reacting to all of these news headlines this week?
Well, so much has been focused on really the monetary policy, the Fed, why we're focused on the jobs report tomorrow. Is like, what is the Fed going to continue doing? And they helped provide this extra stimulus for the markets in a way, going 50 basis points, cutting. We were hoping they were going to make a big cut. We think they should be at neutral, which is a 3.5%, much quicker than they typically tend to do, which is a very slow and deliberate pace. But so you've got this extra booster shot there, and earnings have been coming in good. Like, why is the S&P so strong and the small caps so weak? Well, small caps have had very disappointing earnings, and the mega cap tech can keep powering higher. So the environment has been good for that underlying fundamentals of the market, and you've got the Fed now contributing to a little bit easier conditions.
So when you think about the small caps trade and a little bit of the rotation narrative that we've been focusing on here, it sounds like owning the broader index might be the better approach versus individual company names, because it's just hard to suss out which ones are going to have healthy balance sheets moving forward.
We've been waiting for that all year, and you say, is now this 50 basis point change in the Fed the key impetus? You know, and we're hopeful it is. We thought you would need them to start cutting rates. They're like the only people paying the higher rates from the Fed. You think about your own mortgage, everybody locked in low mortgages, large cap companies extended their bond maturities. Small caps can't issue debt the same way. They're borrowing at these floating rate instruments. So they're paying the higher interest rates, so hopefully these lowering of rates helps ease their interest burden. But you also do need to see the earnings pick up. Now, the economy's been strong. It tends to be, or it's been holding in pretty resiliently. That tends to be good for small cap earnings, but last quarter was not great. So you got to see it as we get to next quarter earnings, have that momentum turn around.
How much does the economic story matter there? Because there is still some ongoing debate about whether the Fed cut 50 basis points to get back on sides while the economy is doing well, as Jay Powell has sort of insinuated that they did, or are they seeing some signs in the labor market that concern them and the economy might actually be slowing? How much does that part of the economic narrative matter when it comes to small caps?
We definitely don't think it's that Powell sees something. We don't think that they have any insight specialty on where the economy is going. They're just recalibrating, as they said. They're realizing they're 250 basis points restrictive to their view. Unemployment's basically at their long-term target. Inflation is trending their direction. Now you have all these sort of short-term stuff, the port strike, the Middle East war. I mean, all that stuff is, maybe that's the transitory, we talked about transitory in 2021 for inflation. We think they will look through some of this short-term noise that inflation's coming down and that they can keep cutting. But it's not that they see some underlying weakness. It's that, hey, they realize they're 250 basis points restrictive from a neutral policy stance, from what they say is their neutral policy stance. They shouldn't be that restrictive.
So when you think about the NFPs we're going to be getting in here tomorrow with that jobs report, do you think that good news is going to be enough for the market, or do you think that the market is obsessed with 50 cuts now, and so unless we get evidence of that, there's going to be more pressure to the downside?
Well, they're sort of pricing in one cut every meeting through the summer, so that would get them to that 3.5% by next summer. We would like them to go faster. But in reality, the good news is good news for the stocks. You want a good economy, you want strong earnings. Now, if rates start shooting way higher, you could say that's going to, like long-term interest rates start shooting higher, people could start saying that's going to pressure the market because, again, they want more cuts, like you're saying. But good news is good news for these companies. When you're at 12 times earnings, 13 times earnings, like a lot of these small cap indexes, you want a strong economy because they're priced for like a slowdown in a recession, but they're cheap. So you need a good economy for those. So we would take a good economy as good news.
And Jeremy, I want to pivot to Chinese stocks because we've seen just a massive rally in that space as we've heard about this stimulus over the last week. I was taking a look at Crane Shares Internet ETF KWEB. It's up, I think, 40% over the last 10 days now. How are you assessing that trade? Is this maybe overdone, or is it something that you think sort of has legs moving forward?
We'll talk about depressed prices, okay? So these used to be, like 3 or 4 years ago, these were the stars. I mean, the China tech was outperforming US tech. They were the market leaders. They're having great growth rates, good valuation. Now they're sort of depressed value stocks. But you say, are they cheap for a good reason, or are they getting overly uninvestable, right? And so that sort of narrative that they were uninvestable is what drove it. And you said all the emerging market flows were EMX China. India, Japan, we've been benefiting from those two countries, and we think long-term, we'd rather be in India, Japan over the long term. The short-run pop is, hey, people are feeling better, they're starting to stimulate. Will it be enough to move their economy is very much an open question. The sentiment was so negative, but there's also good reason why it's tricky. It's a very dicey geopolitical world. You saw what happened with Russia, where we zeroed people out. The US politicians said, you own Russian shares, we're going to make you worth zero. So that fear is with people for the China investments. So there's tactical people who could be nimble and move in and out, but for strategic long-term investors, it's tricky.
Then on the other side, you have the likes of David Tepper saying, I'm buying US listed Chinese stocks, I'm buying the Chinese indices.
Yes.
I mean, what does he have wrong?
Well, he's the example of who I said who could be nimble. So he could be in today and gone tomorrow.
He's got the liquidity.
If we could trade like David Tepper, we should get in China stocks.
But he may not be here for 10 years. He may be, if you're thinking about it's a real long-term allocation for your portfolios, it's tricky. But, now you say, hey, it's priced so cheaply because everybody's afraid of all these geopolitics and it's not going to be that bad. So you can say, yeah, they're good value stocks and the earnings are actually supportive. A lot of negativity is priced into them. I understand that. It's just this ultimate question is, are you rewarded to be in China as a communist country and all the problems with the geopolitics versus the democratic countries like Japan and India that are more U.S. allies versus U.S. adversaries at the moment.
Which is especially prescient given that we are heading towards a presidential election. It seems like no matter who's going to win, there are going to be more walls up against China. Jeremy, we got to leave it there, but thank you so much for joining us.
Thank
really
you.
Appreciate it. Oil prices are continuing to climb here as traders are monitoring that conflict in the Middle East. Yahoo Finance's Inez Ferre is here with us for more. Hey, Inez.
Hi, Madison. And we saw a spike today, and that was after President Biden was asked this morning about the possibility of a retaliatory strike from Israel targeting Iran's oil facilities. And he went on to say, we're discussing that. Then he didn't finish his sentence. We did reach out to the White House for more clarification. But what drove oil prices up today were those comments and the possibility of an interruption of an oil production interruption from Iran, coupled with also the possibility of shipment interruptions through the Strait of Hormuz. Since the outbreak of the conflict in the Middle East, we've seen these temporary spikes that are related to the possibility of Iran's production coming offline, and specifically Citi analysts today estimating that a major strike to Iran's oil facilities could take about 1.5 million barrels daily of supply off the markets. So we saw today the oil going higher. It settled above 5% higher, so it settled above 73 per barrel. You've got Brent crude that settled above 77 per barrel. There's some analysts that say that if you do have some shipment interruptions, you could see oil spiking Brent above $80 per barrel. Same situation with if you see interruptions with the production coming out of Iran. I do want to point out, since Tuesday, the volatility that we've seen with oil, this is a big spike. So this week alone, we have seen oil prices go higher. One caveat being the spare supply from OPEC+. Also, Libya is also restarting their oil production. So analysts are saying, yes, despite these price hikes that you're seeing with oil futures, you do have that spare capacity on the sidelines. So you could have seen oil going even higher if it weren't for that spare capacity, guys.
All right, Inez, thank you so much, as always, for breaking down the oil market for us. We appreciate it.
Thank you.
Well, we're just getting started here on Market Domination. Coming up, we'll speak with a former Fed president about what Friday's all-important jobs report could mean for the economy and for rate cuts moving forward. Plus, shares of NVIDIA moving to the upside on the back of some bullish commentary from the CEO. We'll check on the stock as well as some other trending tickers on the other side. Stick around, much more Market Domination still to come. Friday's jobs report could help define the Federal Reserve's path forward as the health of the labor market is taking priority. That follows the recent cooling in inflation, but we've still got a lot of complicating factors ahead for labor market data. Former Federal Reserve Bank of Atlanta President Dennis Lockhart joining us now to discuss. Dennis, it's great to have you on. Thank you for making the time for us. I mean, even just on a day like today, we're getting mixed pictures when it comes to the labor market. I can pick whatever narrative I want based on whatever data point I could point out to you. Since you've been in the room for these discussions before, tell us how the Fed handles the kind of bifurcation that we're already seeing in labor market data.
Well, for the most part, I think members of the committee have in mind an overall picture of the employment situation, and I think they currently think it's pretty solid. Unemployment at an acceptable level, job gains, monthly job gains that are higher than the replacement requirement, and continuing at a moderate pace. And they want to preserve that. So they'll be looking tomorrow for any cracks in that set of assumptions. That's a kind of working picture that they have of the labor market. And as I said, they'll be looking for information that sort of suggests that their picture is not correct.
Dennis, I want to call up some data from the JOLTS report that was out earlier this week as far as the quits rate and the hiring rate goes. So when you take a look at the quits rate and the hiring rate, both been coming down pretty significantly thus far in 2024. You exclude the pandemic, your quits rate's at about a 2015 level, hiring rate looking more like 2013. What do you make of data like that it seems like one could argue it's cooling and another could argue, oh no, what if these keep going down? That's normally something that would happen leading into a recession.
Well, the quits rate that we saw just after the pandemic in a very, very hot labor market was pretty extraordinary, and it reflected, I think, the view on the part of many people in the labor force that they could improve their situation by improve their salaries by quitting one job and seeking another one. And this labor market is much, much cooler than that, and that assumption doesn't hold any longer. So people are not quitting. They're trying to hold on to their jobs. We're not yet in a situation, and I hope we don't get there, of widespread firing of people, layoffs and such. We've seen just a slowing of hiring, and that feeds the quits rate as well.
How much does the Fed take into account the vibes, Dennis? If I asked all of my friends right now, many of whom are looking for work currently, they would tell me they need the Fed to be cutting by 50 at the next two meetings. To what extent have you seen some of that feeling of consumers come up in conversations within the Federal Reserve's meetings?
Yeah, there's opinion on both sides, meaning the 50 basis point versus a 25 basis point side. And there's a case to be made for both. What the committee has said, at least in the summary of economic projections, is 50 more basis points is the median between now and year end. That could come in 2 25 basis point cuts in November and December, or it's conceivable that they just simply do one cut of 50 in either November or December. So there are tactics involved in this. I think the difference of sentiment out there is sort of how weak the labor market might be, and I don't believe the committee views it as extraordinarily weak. So I think that would probably call for a 25 basis point cut in November.
Dennis, it seems like there are some dynamics right now that might make it harder for the Fed to read exactly where the labor market is when we go to that October jobs report, right? You have a port strike going on right now, about 45,000 workers stepping out of their job. You had a massive hurricane rip through parts of the U.S. That's going to potentially impact some of that labor market data. How does the Fed look at a report like that when it is clearly noisy? Can it still be useful, or do you kind of just have to throw that aside and look at the other data that you've had that wasn't distorted?
Well, the Fed economists know very well the methodologies that go into collecting some of this data, so they can inspect the details of any given report and identify issues or identify matters that they think they should pay attention to. Having said that, you're absolutely correct. We have a lot of noise developing with the port strike and with Helene, the storm affecting at least parts of the United States. And I think that breeds a tendency to look through the data and just treat it as 1 month's noisy data, as opposed to something that really tells you something about the underlying trend.
So for those of us out here trying to predict what the Fed will do next, if we are meant to kind of look through any messiness in the data, what should we look at outside of NFPs for clues about the Fed's path forward?
Well, I think I would start with the top line. The growth indications for the third quarter, based on my former bank, the Atlanta Federal Reserve Bank's GDP now, 2.5% annualized growth. That's a pretty healthy rate of growth. That's above trend. The trend rate of growth, that is the long-term natural rate of growth, is believed to be about 1.8 or 1.9% annualized growth. So I'd start there. Then I think they take a very holistic view of the employment picture, of retail sales, of consumer activity, which is a driver of the economy, of savings rates, of employment data, and try to piece that all together into an overall sense of the health of the macro economy. And to repeat myself, I think they view it as reasonably healthy at this moment.
Sounds like a reminder that they look at the totality of the data. Dennis, thank you so much for joining us. Dennis Lockhart, former Federal Reserve Bank of Atlanta president. Really appreciate it.
Thank you.
It's now time for some of today's trending tickers. And you can scan the QR code on your screen below to check out the best and worst performing stocks of the day's session on Yahoo Finance's trending tickers page. First up here, let's take a look at those shares of NVIDIA rising after CEO Jensen Huang touting high demand for its Blackwell chips. And Josh, what I love about the market sometimes is what else is Jensen Huang going to say other than demand for these chips is insane.
He says it every time and it's still number go up when he says it, right? He talks about demand and it's like, oh, I hadn't thought about NVIDIA's demand. It's the whole story.
Yeah, exactly.
Like, story did not change today, right? But the stock just goes up. Always interesting, too, when we think about NVIDIA's stock going up and what it does to the chip sector, seeing a little bit of a lift in the chip sector overall. But I do think the OpenAI headlines were pretty interesting, too, with OpenAI getting that additional funding. Gil Loria told our Alexandra Canal and Laura Bratton that he thinks that that's going to be a direct flow from that funding round that goes into NVIDIA, right? Because that leads to more demand for chips. He's sort of reasoning that's actually a real base case for maybe NVIDIA will get more demand, rather than Jensen Huang just saying demand for the product everyone wants is great. Maybe there is a little bit of a fundamental reason here to speculate that they might get a little bit more demand, but I think you're right. When Jensen says positive things, the stock goes up.
The stock goes up, but to your point and to our colleagues' points in their reporting, it's not just that OpenAI is obviously going to be spending big on NVIDIA. It's also the idea that the investors see proof in the AI story, that OpenAI's valuation might be proof that the question marks about AI that we've seen over the last quarter since NVIDIA's earnings, which were excellent but not excellent enough, those questions maybe are getting put to bed because there is a use case out there for all the AI.
There's a big use case out there. It might even be robots.
I know.
I want to talk about one company that wants to use AI for robots, Maddie. Tesla shares sliding as the EV maker reportedly plans a $783 million debt sale. That's according to Bloomberg. And really, Maddie, Tesla moving off a lot of news today. So there are also plans for 4 new batteries to be launched in 2026, including one for the robo-taxi. That came from the information. And then also maybe something that might be weighing on Tesla's stock here. They're recalling parts of the Cybertruck. I see 27,000 Cybertrucks being recalled due to a camera issue. We know the Cybertruck isn't really a big part necessarily of Tesla's core business at this point, but it's a car company, and having recalls is never really positive news, so to speak.
Absolutely. I mean, it was hilarious that we picked this trending ticker earlier this morning off of that Cybertruck recall, and then we got 3 major pieces of news about this company throughout the day, which I think is indicative of one of the challenges of being a Tesla shareholder, is that the company fundamentals are tough every single day. There's a lot of news about this name. There's recalls, there's questions about consumer demand moving forward. Earlier this week, we got those delivery numbers that were not necessarily enough for the stock, particularly given that that there was all this stimulus in China, and we thought that that was going to be a huge boon for Tesla. It wasn't. But the stock itself, I mean, it continues to be an expensive stock to short, and so maybe that's something that is enough for shareholders.
Well, you mentioned those delivery numbers. That was something that stuck out to me. Is it feels like whenever we get back to the Tesla fundamental story, it doesn't go that well for the stock.
Yeah.
You think about earnings, right? Last earnings release, stock dropped 12% the next day. Stock was off 4% yesterday because deliveries couldn't quite meet. It seems like maybe next week Elon can take control of this narrative a little bit more with the robo-taxi event. That's up Tesla's alley. Elon said it himself on the earnings call last quarter. If you don't believe in the autonomous story for Tesla, you shouldn't own the shares. So next week is his chance to give the next big pitch for the long-term Tesla story, because that's what's in that valuation. It's an expensive stock. If we were just talking about an auto company, I want to see some robots.
We got to
Show
see
me
the
some robots.
And certainly something that we've been anticipating as this event has continued to get delayed. So excited for it to finally be here for us to cover. But let's stick with the EV space here. Shares of EVgo skyrocketing as the company receives an additional, conditional rather, $1.05 billion loan for its EV charging products. You can see, I mean, ripping here, right? Over 60% on the day. And it's an interesting story here because I think it's indicative of the importance of fiscal policy on individual companies. Here, again, this is $1.05 billion from the Department of Energy to expand charging stalls for EVgo. The Biden administration wants 500,000 of those EV charging stalls to be in the United States by 2030. So big question mark for a company like this. Obviously, they've got this funding in the bag for today, but what happens if we get a different person in the White House come November? Does that start to put some pressure on a company like this?
And it just seems like a key part of the EV story overall, right? You talk to someone like our autos reporter, Pros Subramanian, who surveys these people, and he says one of the biggest complaints that you hear from people that are teetering between hybrid, EV, why have hybrids become so popular? It's hard to find a charging station.
Yeah.
And so to have this stimulus come in, yes, very good for EVgo, having its best day in about 3 years here, the stock is. But overall, I think maybe for the EV charging story, if you can get more of these back in place, maybe we start shifting that conversation from everyone wants a hybrid back to, okay, I'm actually comfortable with an EV because the next charger isn't 400 miles away.
Well, and to your point, JP Morgan cited exactly that EVgo owns every part of the operation here. So no matter what, if we get some more chargers in the US, they're going to be a beneficiary of that.
Something to watch, Maddie. We got to plug in those cars if we're going to drive them, right? All right, moving on. Southwest Airlines flying higher after a member of its board purchases 3.6 million shares of the carrier's common shares. So Southwest executive coming in and buying shares here. This is in response. He joined the board after Elliott had launched an activist position in the company. So sort of in response to that, you see shares getting a little bit of a pop here. Southwest earnings coming out at the end of October. We're going to hear from Delta before that, get a little bit more look into where airlines stand right now. And I think it's a little bit story to be seen here over the next month or two as far as what the fundamentals are looking like for the airline and travel space. We've talked a lot about potential of a consumer slowdown or people still traveling. Where is the economy headed over the next 6 months? Airlines are a big part of that story, so it'll be interesting to watch and hear what they're seeing in their actual demand going into the end of the year.
Certainly, and it's fascinating given that the activist investors have called for a meeting to discuss the appointment of some of these directors to the board, including the director who purchased all of these shares. But when an insider buys a lot of shares, sometimes that can be a bullish signal for the stock. You can see, though, tough year for Southwest, lots of volatility, up just a little over 4.5% year to date.
All right, coming up, Alphabet CEO saying the company is targeting electricity from nuclear power plants for its data centers. We'll speak to an analyst on the other side about what the move could mean for energy stocks. Stick around, much more market domination still to come.
Alphabet CEO Sundar Pichai is saying that the company is targeting electricity from nuclear plants for its data centers. Now, this comes against the backdrop of multiple nuclear plants set to reopen in Michigan and Pennsylvania that'll help fuel the AI boom. For more, we're going to bring in Durgesh Chopra, Managing Director covering power and utilities over at Evercore ISI. Durgesh, thank you so much for being here with us. So it's interesting. It feels like, to those of us who just cover markets and don't necessarily make money off of it, that overnight these nuclear plays were just booming, right? Vistra overtaking NVIDIA for gains in the S&P 500 year to date, for example. What do you think was that single catalyst that kind of pushed these nuclear plays into the foreground here?
Well, thanks for having me. And just broadly speaking, IPPs, whether it's Constellation, Vistra, NRG, the single largest catalyst was the need for clean energy, 24/7 energy by these data centers, which these non-regulated power producers have and can channel to these companies. These companies need the power now, and nuclear, the non-regulated nuclear operators like Constellation, like Vistra, like PSE&G, are able to enter into long-term contracts and provided that 24/7 power to them, which also has the clean energy attributes.
3 Mile Island reopening, one of the sites reopening there. I mean, I didn't have that on my scorecard for 2024 for something that I was going to read in the news. Is that something that investors should expect more of? Is it nuclear power plants that we know of that are closed that these companies are going to be going to and finding opportunities to reopen? I mean, how big is that opportunity there?
Yeah, Josh, you and me both. That's right. 3 Mile Island is coming back online. I think there are other opportunities. Palisades, you mentioned in Michigan. There's NextEra's, Duane Arnold plant in Iowa. So I think that besides these opportunities, the combined add up roughly around 1.5 gigawatts. There's also uprates or efficiency gains at these nuclear plants, which these companies are going to pursue. But yes, that's going to be the next big thing.
Is the market potentially getting over its skis given some of the regulatory pressures that could come even with regards to 3 Mile Island here?
I really think that, there's a lot of demand here that needs to be satisfied. 3 Mile Island coming back is actually a really good thing, right? Because they're actually adding new capacity to the PJM market, new supply. I do think the points you're raising are valid. We have to be careful to balance this demand trend that we bring supply on time while also not disrupting the balance of residential customer bills. So I think that's a key challenge, but this is a good position for utilities to be in. We haven't seen demand growth in decades, the top line growth, and we're finally seeing it. So this is an opportunity, but like with power comes a lot of responsibilities. I think this is one of those circumstances.
Durgesh, you just mentioned utilities. I want to talk utilities broadly for a second here, right? And just talk about XLU. It's the leading sector in the S&P 500. Was looking at a chart today. It's trading well above its 200-day moving average. The sector hasn't been trading this high above that technical level since the dot-com bubble. I mean, do you think just the sector as a whole is perhaps overbought in some ways? And how should investors that are hearing about utilities, hearing about this energy boom, how should you sort of assess where to get in there and where to pick your spots?
Yeah, I don't think it's overbought. So if you look at the sector, just much like the S&P 500, there are 4 or 5 stocks, which are the IPPs that we just talked about, and some of the diversified companies, all power producers. They are driving these gains. I tell you what, looking here, some of these IPPs may seem expensive on earnings, but there's a tremendous amount of EPS upside. We layered it out in our research, but there's about 30-40% earnings upside. So no, I think there's more to go. I think the UTY or the XLU ends the quarter outperforming the market, led by these IPPs and the diversified names. The regulated utilities, they've kind of, if you look at them, performed in line with the S&P 500, the more traditional utilities. But again, there's a ton of upside for them as well with the CI trend. Rates moving lower is a tailwind. Inflation coming down is a tailwind.
When do we start to see everything that we're talking about, to your point, start to come up in these company earnings? Like next quarter, is Constellation going to totally rip after their earnings print, or will it take a little while?
No, I think it takes a while. I think they just made an announcement, and I think the CEO has been very clear that these are opportunities over the longer run, right? The 3 Mile Island earnings don't hit until 2030. That's going to be the story for the rest of the utility sector. Look, the reality is you build something new today, whether it's a gas plant, whether it's wind solar storage, small modular reactors, they all of these technologies are 5 to 7 years build time, right? And small modular reactors is very nascent technology. So these things are going to take some time, but they're all additive to earnings and should boost the long-term growth profile of utility sector.
Durgesh Chopra, appreciate you joining us today. We're going to have to wrap it there. All right, now let's get on to our call of the day, sponsored by Tasty Trade. Citigroup out with a new note on Hims and Hers. The note highlighting recent developments from Eli Lilly that could impact the stock. So, Maddie, the FDA officially removing tirzepatide from its shortage list here. That impacting Hims shares. Hims shares taking a massive leg lower today, now only off 10%. It was off more than that when I was taking a look at shares earlier. This, of course, comes as Hims has had quite a run in 2024.
Yeah.
Stock has been up significantly because they were able to get in the GLP-1 game off the back of this shortage out, perhaps Hims out, right? And now you have Eli Lilly potentially benefiting from that. Seems like maybe something that's kind of weighing on what was the bull case for the stock here.
100%, because just to give our viewers some context in case you're not familiar. So a company like Hims and Hers can sell the compounded version of these drugs, and they actually are focused on semaglutide, which is not the form of GLP-1s that is coming out of the shortage list. That was actually tirzepatide, as Josh, you mentioned. Semaglutide is still on the shortage list. So Hims and Hers is okay for now. They're selling a compounded version of this, and you're able to do that when the FDA puts a certain drug on the shortage list. But at some point, these drugs are meant to come off the shortage list. So then what happens at that point? Can individual consumers who are buying from Hims and Hers just go through their insurance and get it even cheaper, get these drugs even more affordably? That is potentially a big concern moving forward. And Citi actually notes that it could also be a regulatory issue. They could see some lawsuits ahead for Hims and Hers. You never want a company dealing with that.
No, absolutely not. Yeah, it's expensive to deal with a lawsuit like that. And the other thing that I found interesting just thinking about this stock overall, I actually went back to a recent episode of Goodbye or Goodbye we had on the show with Dave Mazza from Round Hill Investments. He had listed Hims as a good buy, essentially for this reason, saying he wasn't a buyer because of the run that we've seen in the stock. And maybe the good GLP-1 news is priced in, and some of the only news to come would be bad news of the regulatory issues coming down the pipeline, of things coming off the shortage list. And when you see a stock go up over 150% in like a 5-month period, maybe you need to wait a couple earnings reports to get a better case for that fundamental story before you want to come in as a buyer.
Especially when you've got the likes of Eli Lilly, a huge beneficiary of this news today. They're ultimately going to be the ones that are selling this drug in
they're the pure play.
They're the pure play. Thank you. They're able to sell it through FDA-approved methods, and that's the big question mark moving forward for Hims and Hers is what's going to happen moving forward from a regulatory perspective.
It'll be a story we will definitely keep tracking. But I want to move on to top players in the athleisure wear arena, and they're feeling the burn right now. Nike recently missing expectations for first quarter revenue, posting a 10% decline. But the retailer not the only one that has shown signs of a struggle. Over the summer, Lululemon reset expectations as it adjusted its full-year guidance lower. Here with more on the shifting athletic wear landscape, we have Ashley Owens, Vice President and Equity Research Analyst with KeyBanc Capital Markets. And Ashley, I want to start with Nike. We saw, obviously, another move down in the stock this week post earnings, and Nike sales have been struggling for a while now. And I keep reading through that earnings call. My key question is this a Nike issue and a Nike management issue? Or is Nike telling us something about the consumer or maybe the athleisure space as a whole?
Look, I think that's the question that everyone's asking right now. And I think the most important takeaway in the piece that we have to focus on here is kind of how Nike gets back to performance and really starts to win again. You know, the announcement of the recent CEO hire was really positive on the day it was announced, but this is not something that's going to happen overnight. I don't think there's any fundamental issues right now with the athleisure space, but as we're looking at Nike, we do think that they need to find a way to kind of reconnect with their customers again and compete in running, lifestyle, and provide customers with new products that they really want to get their hands on.
To what extent, Ashley, do you think that a new CEO is going to be able to impact some of those factors you just mentioned?
Yeah, definitely. You know, Elliott is a longtime veteran of the company. He's being brought back in, obviously. He has a history of helping with the marketplace aspect of the business, and I do think that it is positive, at least from internal sources, that this is, it's a nice restructuring and kind of redaction of the company. Reminder, though, that this is a company that's built on innovation. This is something that it started with a waffle iron. I think that Nike needs to get back to that headspace of really putting innovation first, and that will lead them back to being successful. But I do think, given Elliott's tenure and history with the company, that he's a good person fit to lead the charge.
Ashley, when you think about competitors in the space, if you just mentioned products, and it feels like no one can talk about Nike now without also talking about an on-holding. I see more people wearing on-holding shoes in New York City now than I do Nikes, it feels like, when you're walking around the streets, or Hoka's with Deckers, right? I mean, what's the competition doing to Nike? And if I'm an investor, should I be looking at maybe those up-and-coming companies rather than getting in on Nike stock?
Yeah, look, the up-and-coming companies, like you mentioned, On and Deckers, are doing really well, and there's no secret about that. I think what's been key for them and what's crucial, again, in this space to really stay competitive is making sure you're focusing on newness and innovation and taking a balanced approach, and also just really focusing on expanding your offerings a little bit. So On's done a really great job over the past few years of kind of expanding outside of that traditional cloud shoe that they were really well known for. Now they have several solid franchises with running and lifestyle that they can kind of rely on. If we look at Hoka, kind of similar thing that's going on right now. You had the Clifton and the Bondi, those are kind of their top two, but we're also seeing some really good progress and performance within the new innovation of the Skyflow, as well as the Mach 6. So all a little different from each other, but really helping to kind of establish and maintain their footing in performance running. So I think, in order for them and for Nike to kind of be successful again, re-entering this market and trying to get back into that performance running category, they have to have strong products that really appeal to a broad base of customers, and then making sure that the customers themselves are doing a good job connecting to the brand and the brand messaging.
Ashley, I love it. A little something for the sneakerheads there. But I do want to switch gears a little bit and talk to you about Lululemon. I know that Lulu is going to have their investor day in Shanghai next week. It's their first time having an investor day outside of the US. And I'm wondering, from your perspective, is that Lululemon trying to tell investors a story about China growth that may not necessarily come up in their earnings in the future? Or is there a real growth story to be had for Lulu in China?
I think there definitely is a growth story to be had for Lulu in China. If you go back to the last time they provided a long-term guidance of the power of 3x2, China was a big pillar of them and a big focus, and I think it still remains that. So as we look at the noise and what the stock's been doing this year, I think some of that growth that we've been seeing in the China market has been overshadowed by some of the softness we've seen in the US women's business. So I think it'll be a great opportunity for us to get our hands on and really see what's going on in that market and all the exciting opportunities that they have there.
All right, Ashley, we got to leave it there. Really appreciate you joining us. Thanks so much.
Thanks so much.
Coming up here, it's the latest edition of the Yahoo Finance Investor Playbook. We'll take a deeper dive into the best ways to be positioned in the regional banking space. Stick around, much more market domination still to come. The banking sector getting a boost when the Fed decided on that jumbo 50 basis point cut. With regional banks in particular positioned to take advantage of lower rates, where should investors be looking for more value ahead? Just a few minutes left before that closing bell on Wall Street. We are looking at how to play regional bank stocks with the Yahoo Finance Playbook. Joining us now, we've got Christopher McGrady, KBW, Stifel Company, and head of U.S. Bank Research. Christopher, it's great to have you here. So talk to me about kind of the relationship between rate cuts moving forward and regional banks. We love to have the 25-50 debate. I'm sure you and your colleagues do as well. How important is the degree of rate cuts this year for regional banking stocks?
Great, thanks for having me back. The 50 basis point move was in much debate, going into the Fed meeting in mid-September. But really, from here, we think the path is more 25s, and ultimately we're more concerned about where you land on rates. And as a firm, we think rates are going to 3% by the middle of 2025. The banking industry typically does better when rates are going up than down. But given the speed at which we tightened over the last couple of years, the opposite is true. We think banks will actually do better. Earnings will expand at a better pace as rates go down over the next 1 to 2 years.
So, Christopher, as rates come down, banks might do better. Is it all regional banks that we're talking about here? Should I be buying the regional bank index, or is there something that you're scanning for that makes certain regional banks better than others?
It's a bit of an unwind or a catch-up trade. As the yield curve has disinverted, we have a positively sloped curve for the first time in a couple of years. Traditional spread-based lenders should do better. So banks that make their money loaning money out and making a spread, they should do better as rates come down. We think companies like Comerica, historically one of the banks that you'd want to own on the upcycle, is actually one of the best plays on the way of the down cycle. Part of that is because of the balance sheet setup with the swaps that they put on. But overall, the small regional banks should do better than your traditional universal money center banks that did better on the way up. So it's a bit of a torch passing between the groups.
Okay, so Comerica is a buy for you, but what is a regional bank stock that investors should be wary about?
I think commercial real estate broadly is still an asset class we're concerned about. It's gotten a lot of attention as rates were going up. Banks are really doing a lot to take down the commercial real estate concentration. On average, a small cap bank has about 40% of their loan book in CRE. So we're generally a little bit more cautious than that. Now, having said that, lower rates help cure some of the problems. So we think credit quality is in the process of normalizing, but lower rates will certainly take off some of the pressure for commercial real estate.
Chris, you say regional banks, and I think some people still have a bad taste in their mouth, right? From a few Marches ago, and you think about Silicon Valley Bank or one of the other regionals that struggled. How much of an issue is what we saw there still in the space, or is that not an issue that investors should still have at the top of their minds?
No, there's still scars. There were some pretty severe moves last March, but we have picked up the pieces. The industry has proven resilient. The deposit situation at the industry level has proven resilient. We're back to growth, and more of the conversations are less of the conversations are about sustainability and will the bank survive? But it's also like what is the normalized earnings power of the sector as we've picked up the pieces, and we think over time, in 2025 in particular, we're going to see positive earnings growth. We haven't seen positive earnings growth in a couple of years. Earnings, we believe, will be down 8% this year. We'll grow 8% next year, and we'll grow 12% in 2026. So there is a path towards improved returns for the sector, and I think that's a good sign to be.
I want to kind of put a button on that, though, because I get what you're saying, that it's a little bit more of a long-term play, but I am concerned about this idea, or I guess investors may be concerned about this idea of future rate cuts already being baked into regional bank stocks. To what extent do you think that is the case right now?
Sure, the group has acted better, but we put out a big piece this week that looked at long-term multiples and the outlook, comparing that to the outlook for net interest income growth. If you look at the average multiple for a regional bank, small and mid-cap bank, for example, we're still 15% cheap to the 7-year average. So there is room for the multiples to expand. We think they expand for two reasons. Number one, if you start to see positive revenue growth. And number two, if we can prove out that the credit situation is more stable than people had feared a year ago. If those two happen, you've kicked out two of the large bear theses for the stocks. But banks have moved, but they're still 15% cheap to long-term averages.
Chris, we were talking about the Fed cutting at the beginning of this, and we know the path is lower now. Maybe it's 25s. I guess to throw an alternate scenario at you, there's still that no landing scenario out there that some people would pitch to you, right? That the economy keeps doing better than you expect, and we just get far less rate cuts over the next 12 months than you expect. How much does that hurt the case for regionals?
Yeah, there's a lot of expectations for the cuts. I would say as a firm and as an analyst, over the last 3 to 4 months, I've definitely moved and I've tilted the portfolio, if I were managing money, to less higher for longer stocks and more banks that will do better in a down rate scenario. I'll give you a couple of examples. Comerica is a stock we upgraded September 4th. Really, when the Fed cut, we thought the capital improvement and the earnings improvement narrative really got easier. At the same time, we took off 2 of the best performing higher for longer stocks, Wintrust Financial out of Chicago and First Horizon out of Memphis. The fundamental stories, in our opinion, have played out. I don't think we can totally abandon, banks that do well on higher rates, and I don't think we can totally go to one end of the boat for down rates. So you do have to have a balance, and I hear you there, but I think in general, the incremental dollar into the space is coming into banks who you believe will benefit from down rates.
Chris McGrady, we're going to have to wrap it there. Appreciate you joining us today.
Thank you.
All right, well, we're wrapping up today's market domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
That is the closing bell on Wall Street. And now it is Market Domination Overtime, sponsored by Tasty Trade. We are joined by Jared Blickery. He's going to get you up to speed with the market action from today. But let's take a look at where the major averages ended up, Josh. Obviously, again, we've got a sea of red, but we did see the Nasdaq recovering just a touch into the close, nearing the flat line, barely below the flat line there. And you had the S&P also recovering just a bit from its earlier moves to the downside.
It's been interesting to watch the market action throughout the week, Maddie, because it feels like it's been a little bit of wait and see ahead of the big macro data tomorrow. You had, I guess I don't even know if we call it a sell-off. The S&P down a little bit over 1% on Tuesday, but outside of that, it's been a little bit of a trend down and then kind of come back up a little bit. You see a little bit of a recovery there, of course, lower on the week, but it was interesting to see the Nasdaq come back, really led by Nvidia today. Nvidia surging, I think it was over 3%. And so when you see Nvidia go up, that's been something that's helped lead the Nasdaq, of course. So that was sort of one of the bigger stories on the day, at least for me.
Absolutely. You can see there Nvidia up over the last couple of sessions as well. But Jared, let's get over to you for a closer look at today's sector action.
Well, thank you. I was watching the indices too. Not a whole lot of action there, but I do want to check out three derivative market. Well, at least one derivative market that's given me a little concern. The VIX is now back over 20. I'm just going to show you on a 3-month basis. Here's that big spike we had with Yemageddon. So we're not quite there, but if you look at the candlestick charts, we are right in the area that we had in early September, and it looks like we want to head a little higher. So what could keep it propelled in that direction? Well, I'm looking at two things. Here's the 10-year T-note yield. That has been on the advance in large degree. Higher rates, not necessarily good for the whole market. Some of the market, yes. But what's more concerning is the US dollar index, which is now 4 days straight in the up direction. It is now cleared just a little bit, this resistance right here, which tells me it has room to run. And a strong dollar is not a good environment when the Fed is lowering rates. That just hints that the world might be in a little bit more trouble than we realize. But that's just a yellow warning for now. Sector action, only energy and tech finished in the green. Energy up 1.75% or thereabouts. Consumer discretionary was the biggest loser or laggard, followed by materials, followed by real estate and staples here, each of those down about 1%. And if we take a look at our leaders, it was small oil, that's PSCE, followed by Bitcoin and then cannabis stocks and then chip stocks. So interesting smatter of green there, but to the downside, guess what? China had a rare off day, just rare in the last, I would say, 10 to 20 trading days, because in that time, in 10 trading days, you can see still holding on to lots of gains there, guys.
It has been quite the rally in China stocks. Jared, appreciate you breaking that down for us. All right, for what is ahead for the markets, we're looking ahead to tomorrow's jobs report. Joining us now, Oh-Sung Kwong, Bank of America's U.S. and Canada equity strategist and director. Oh-Sung, I want to start with that non-farm payrolls report we're going to get tomorrow. What do you think markets want to see from this report? Is it a good news, meaning maybe more payrolls than expected, unemployment not picking up is going to be good news for markets, or are investors really hanging on to that rate cut story and they want to see 50 bips in a weaker print?
Yeah, thanks for having me today. Yeah, I think good news is good news for the market, and it has been that way over the past few months. So our house view is 150,000 jobs in September, which is basically in line with what consensus is forecasting. And 150,000 is basically a good number for the market. It's in line with consensus, no big surprise. And we think that the Goldilocks range for equities for the jobs market is anywhere between 125 and 175,000. So as long as we stay in that range, which is a pretty solid number, then I think equities and the soft landing narrative can continue.
Oh-Sung, it's fascinating because we keep talking about this idea of clarity to come from the jobs report, that the next one we get, we're finally going to be able to have that be the thing that is the next big catalyst for the market, and we finally have complete transparency into the Fed's move forward. That's why we've seen this kind of range-bound movement in the S&P 500 over the last 8 sessions here. Are we actually going to get some clarity tomorrow?
Yeah, I mean, it's hard to tell. The jobs market has obviously slowed down, but it's not falling off the cliff. And I actually think that with the Fed doing 50 back in September, the range of that Goldilocks that I mentioned, 125 to 175, that probably would have expanded to to a little bit to the downside as well. So I think a slight miss could potentially be overlooked by investors, given that the Fed was pretty aggressive with the beginning of the easing cycle. And if you do get a miss, then the likelihood of another big cut is going to go up, which is also good for equities. And 150,000 jobs that we are forecasting, that's basically not too hot, not too cold. It's basically Goldilocks for equities.
So if we stay in that not too hot, not too cold area for economic data, really moving through the rest of the year here, where's the opportunity for investors to kind of keep trading that Goldilocks soft landing scenario?
Yeah, so we really like the rate-sensitive sectors within the market. I think the broadening out theme is going to continue going forward. And we have seen that in Q3. I mean, in Q3, we basically saw, one of the best breadths in history. I think it was like 69% of companies or stocks outperforming the S&P 500 in Q3. Rate-sensitive sectors that were beaten down over the past 2 years, given the hiking cycle, I think the reversal is going to be much more favorable for those sectors. And the two sectors that I'm really watching closely are manufacturing and housing. I mean, a lot of people are saying that the hiking cycle didn't really have an impact on the overall economy, which is 70% consumption, 70% services. But if you look at underneath the surface, for example, manufacturing and housing, they have actually been in a recession. The IXIC manufacturing PMI has been below 50 for the past 24 months, except that 1 month, which has been the second longest downturn in history. Existing home sales were down as much as 40% at the trough, which was even more severe than during the financial crisis. So with easing rate pressure plus the destocking cycle of the inventories, that we think is over. I think those two things are really going to boost the manufacturing as well as the housing cycle. And if that's the case, if those sectors come back, that's going to be a major boost to earnings for the S&P, especially more beaten down, fundamentally challenged stocks from the hiking cycle over the past 2 years.
So I want to zoom in on earnings for a second because we have earnings season starting to pick up here soon in earnest. And I'm curious, you mentioned the broadening out. That was obviously a theme that we saw last quarter, the S&P 493 finally turning positive on year-over-year growth. Is that the key theme you're watching going into this earnings season for that to continue, or is it something else that's sort of top of mind for you going into earnings?
Yeah, I think this earnings season is going to be pretty tricky. I don't think the big focus is on Q3. Everyone basically knows that Q3 wasn't a very strong macro environment. Macro has slowed down. So I don't think the expectations are that high for Q3 to begin with. If you look at Q3 consensus numbers, EPS is expected to be up 4% year over year, which is a pretty big deceleration versus up 11% that we saw in Q2. So I don't think the bar is that high, but also the focus isn't really about Q3. It's really about companies' outlook on the other side of the curve now that the easing cycle has started. What companies are going to say about any early indications of improvement given the lower rate environment? I mean, I think it's too early, but even a little bit of improvement in terms of sentiment, plus China, FX pressure is easing. So things like that, I think, are going to be the main focus this earnings season.
All right, Osam, we got to leave it there. Appreciate you joining us. Thanks so much.
Thank you.
Let's take a look at the semiconductor industry. Most folks might associate the semi space with countries around the globe, even here in the broader country. But there's a small town in North Carolina that's imprint on the sector is shockingly critical. According to Bain & Company, about 80 to 90% of global quartz supply coming from spruce pine, and almost every cell phone and computer chip contains quartz from the small southern town. So what does this mean for the broader semiconductor industry amid challenging weather conditions? Joining us now to discuss, we've got Peter Hambury, Bain & Company's partner and leader of operations for tech practice. It's great to speak with you here. So I just want to start by giving our audience a little bit of context. Talk to me about the relationship between this town and the semiconductor industry in just 60 seconds here.
Sure. Yeah, I mean, the situation in North Carolina has the potential to have a big impact on the industry if it lasts for more than 6 months. And really two reasons for that. One, the high purity quartz produced is really critical to the industry in two ways. It helps produce the silicon wafers that form the basis of all semiconductor products. And it's also used in the wafer manufacturing tools used by TSMC, Intel, and Micron. And then there's not really a lot of suppliers in this space who can meet the purity requirements of the industry. And the complexity of the manufacturing process requires months of work to qualify new suppliers. So it's very hard to switch. So together, the criticality and challenge of adding new suppliers means this a potential for a big impact is possible here.
And Peter, you mentioned if it lasts for longer than 6 months. I mean, how do you sort of assess that risk of, is it going to last more than 6 months? And how are you sort of weighing those two different options there of it maybe being short or maybe going longer than we think?
No, it's a great question. And it's one of the challenges of the industry. And the best players in the industry recognize these bottlenecks and spend a lot of time identifying where these bottlenecks are, developing proactive mitigation plans like additional inventory, and monitoring their supply base. And the best players would have known this potential impact was coming about a week ago. So as we look at the impact, we see several months of inventory along the value chain, which will limit the immediate impact. A few years ago, during a lot of the shortages, this would have immediately flown through and led to a larger disruption. But given the utilization and lead times have returned to normal over the last year or so, we've got a little bit more buffer in the system to absorb shocks like this. So we don't know the exact impact of the damage or how long it'll take to get the facilities up and going again, but we think there's at least a couple months of inventory to limit the immediate impact.
And Peter, I'm just curious too, to take a step back for a second. For folks who are listening who have no familiarity with quartz, can you talk about the everyday devices that could be impacted by this?
Yeah, I mean, as a part of the semiconductor manufacturing process, every form of logic semiconductor, NAND, DRAM, or memory, or even solar devices, for example, the solar cells on your roof, all use these components to make the individual chips. So you would see them in your smartphone, notebook, the servers that support all of the web pages you interface with, and even a lot of the power delivery into your house, for example, would be driven by semiconductors. And so that impact could spread quite widely and impact a lot of folks, similar to what we saw with the chip shortage.
Absolutely. And I think it points to this broader challenge that certainly the government has been working through, which is domestic chips production. I'm curious from your perspective, what this story tells us about the importance of increased competition in the chip sector, just to diversify a little bit.
Yeah, the chip sector in general is inherently challenged. The technical requirements of the process, being able to print 30 trillion transistors on a dinner plate, means that the technical requirements of the industry are massive. And that's up and down the value chain. And the amount of R&D and scale required to be successful is massive. And so you end up with many single sources of failure within the industry, heavy levels of consolidation. And so obviously a lot of the CHIPS Act funding has gone towards the manufacturing itself, the Intel, Samsung, TSMCs of the world. As you think about the broader resiliency of the industry, you do have to look multiple levels deeper to include the equipment. Quartz would be an example of a subsystem. The materials that go into semiconductors, you'll see this level of concentration and risk at many places in the industry.
All right, Peter, we got to leave it there. Really appreciate you joining us. Thanks so much. Coming up, the Fed has signaled 50 basis points of cuts to come this year, but one economist says that's not enough. More on that when Market Domination Overtime comes back.
Well, the Fed is expected to cut interest rates 2 more times this year. The size of those cuts remain uncertain. Our next guest today says the path to another 100 basis points worth of rate cuts between now and year end seems increasingly clear. Let's welcome in Neil Dutta, Renaissance Macro Research Head of Economics. Neil, I want to talk about this 100 basis point call that you made earlier this week and seeing that kind of increasingly coming into view. Is that about the Fed just being offsides and being too restrictive at this point? Or is it what you're seeing in, say, the labor market data and how much it's weakening that you feel like they need to cut by 100?
Well, thanks for having me on, Josh. Good to see you. It's a little both, actually. I do think that, the call on 50 is really a call on the jobs number clunking between now and the November FOMC meeting. I don't think it's a particularly high threshold. The momentum under the labor market is clearly softening. I mean, I think the 2 most important data points that have come out in the last 2 weeks is first the Conference Board labor differential, where consumers being surveyed are telling you that it's increasingly difficult to find a job. They're telling you that jobs are hard to get. Historically, that's had a very strong contemporaneous relationship with the unemployment rate. And second was this week, we saw the job openings and labor turnover data, and we know that the quits rate has basically plumbed new depths. We see that the hiring rate is essentially at lows. And so, there's really just not a lot of inertia in the labor market right now. And things like quits and hires, frankly, those are consistent with an unemployment rate somewhat higher than 4.2%. So I think the direction of travel, frankly, is clear. And, in my mind, it means the Fed's still a little bit behind even after doing 50. Now, I think the good news is that there's very little doubt in my mind that if you saw a weak jobs number, that would kind of, lead to this sort of aha moment that would probably get the Fed to take a more aggressive approach to getting back to neutral. But right for the time being, they're a little bit more reactive than proactive, and I think that's kind of a problem. But that's why, to me, it's just important for, I think, your viewers to understand, just because the summary of economic projections, I heard you mention that before, just because that has 2 cuts baked into the outlook of 25 basis points, so spread evenly in November and December, that means nothing, because the forecasts that the Fed puts out are conditional. Could you imagine anchoring to the June SEP, the June summary of economic projections? I mean, how would that have worked out? And you wouldn't have even come close to thinking about a 50 basis point move in September. So estimates are conditional, the forecasts are conditional, and conditions can change. And I do think that we'll probably, we have, I think, more weakness with respect to the labor market in front of us than people appreciate.
Okay, so Neil, there's the labor market side of the dual mandate, and then of course there's the inflation side. And I love your confidence here. I wish I could take some of it from you. You say, why take chances when inflation is resolved? Is inflation resolved? I mean, you've got energy prices skyrocketing. You've got prices paid way up today.
I mean, skyrocketing. I mean, that's a bit of a stretch. I mean, I think you've seen some increase in oil prices because of what's gone on overseas. But generally speaking, gas prices have been coming down, at least over the last several weeks. Now, obviously, oil prices going up will upset that a little bit. But ultimately, it comes, to me, inflation is a process, particularly outside of commodities, okay? And what I know about inflation is when I look at unit labor costs, they've basically been 0 over the last year. So it really begs the question about where the inflation is going to come from. And when you're talking about energy prices going up, what you're really talking about is a relative price increase, right? So if oil goes up and people start paying more for energy, that means that they'll have less to spend elsewhere, ultimately cutting back on those goods and services, which will in turn bring the prices down for those goods and services. So that's a relative price shift. I don't think it raises the overall price level, which is what inflation is. So I think it's important to think about inflation as a process, and it is a process outside of commodities. And the fact that unit labor costs are so low really begs the question as to where the inflation is going to come from. And we also know that we've had fairly encouraging inflation data since May. I mean, remember, over those 4 months, core inflation's actually been below 2%. And that's happened despite very little effort from housing rental inflation. I mean, housing rents haven't actually been that cooperative. I still think that there's probably a pipeline of disinflation in front of us with respect to rents, and that should take additional pressure off of underlying price inflation.
Neil, I'm curious about the ongoing strikes that we have right now, the hurricane that just ripped through southern parts of the U.S. It feels like things that could add up and distort something like the October jobs report, right? And maybe take non-farm payrolls down a little bit lower. How does the Fed read a print like that? Like, what do they do with that? That's going to come out right before the November meeting. If it comes in soft, do they just overlook it because there's all these distortions?
I would hope not. I would hope not. I mean, could you imagine Jerome Powell getting up there and delivering a 25 basis point rate cut in after what could be a potentially negative employment report? I mean, it's important to keep in mind that, we have the Boeing strike, we have the port strike. I mean, maybe these get resolved before the reference week, which was basically October 6th through 12th. But we also know that, the tragedy that's happening in the southeast of the country, in parts of like Asheville, I mean, this is their peak tourism season, right? Mm-hmm. So if you think about it seasonally, it couldn't have come at a worse time. So I think, like anything, if you're like a politician, in politics, they talk about how if you're explaining, you're losing. I mean, in some respects, that's true of the Fed chair, too. I mean, if he's going up there and he's trying to say, well, the jobs number would have been 150,000 if it wasn't for 50,000 here and 50,000 there and 50,000, over here. I mean, I think it would sound kind of ridiculous. So, I think you sort of hit the nail right on the head. I mean, I think you have a lot of potential distortions. And again, I mean, I think that the optics of not doing something big after a very weak number would be very challenging for them to communicate.
Yeah. So Neil, I know that you were a soft landing guy pretty early when some other folks in the space were not on that train. Did the Fed mess that up for you? And how elevated do you think the potential risk is of a recession now, given that you think the Fed is moving too slow?
Well, I mean, the recession risks, these things ebb and flow. I mean, I think I generally think that the Fed should have started earlier, but I also think that they did take off some risk by going big in September. My own sense is that recession risk, to me, it's ultimately, what do you think the Fed is going to do in the face of bad data? And I think if you get weak data, the Fed is going to get very aggressive. And that gives me some confidence that recession will be avoided. Ultimately, it's a call on the Fed. Now, if they continue to think that they can string out a bunch of 25 basis point rate cuts, even as the data is softening, then I think that would worry me. But, I do think that this is a Fed that is not locked in. It's a Fed that's reactive to the data. And if the data worsen, then I think they're going to get aggressive and probably take out some insurance going into the end of the year, sort of not taking any chances. So that's why we think that they'll do 50 and 50. Because at that point, I mean, you've basically seen several months now in a row of very weak employment data. And importantly, a lot of this is happening after Powell said that he didn't seek any, or he didn't welcome any additional cooling in the job market. Right. So I do think that, sticking with jumbo moves in the face of that would make sense. And if the Fed's willing to do that, then I think that would mean that recession sort of probabilities come down.
Well, Neil, we got to leave it there. But if we get a negative non-farm payrolls print, I really hope that you will make some space in your day to come back on and talk with us about it. Neil Detta, Macro Research, thank you so much. Let's hope not, but if they do, we get to talk again. So all good in the end. Thank you, Neil. Appreciate it.
Thank you.
Netflix's stock has been on an absolute tear since the start of the year, but despite its success, it doesn't mean the streaming giant can just relax. Joining us now, we've got Yahoo Finance's Alexandra Canal for more. Ali, great to have you on as always. So what is next for Netflix?
Well, that's a loaded question, Maddie. And in exactly 2 weeks, you're going to get a little bit more of a clue because that's when Netflix is going to report their earnings. Expectations are certainly elevated heading into this print. As you just alluded to, the stock is up nearly 50%. We're expected earnings to go up about 40% with revenue expected to climb 15% from the year ago period. So a lot has been really baked in to the stock price there. But Netflix is one of those companies that's really been burdened by its own success, especially when we talk about metrics like viewership, metrics like engagement. These are data points that the company started sharing last year in a push to be more transparent. And it does give investors, analysts, a better idea about really what makes Netflix tick. And we now have enough reports to analyze some of those year-over-year trends. But this is where some of the concerns come into play here, because when you look at those aggregate reports, year-over-year engagement on the platform was pretty much flat. According to that viewership data, we saw subscribers watch over 94 billion hours on Netflix from January to June. That's only an increase of about 1%. Now, Netflix told me that they are not that concerned with these engagement levels. They actually think engagement is at a healthy point as they continue to really ramp up their content slate. But for analysts, this could be a bit concerning. MoffettNathanson's Robert Fishman said that a lack of engagement growth, that could mean insufficient pricing power moving forward. And we know how important pricing power is for a lot of these streaming companies. There's a ton of competition. The consumer is becoming more choosy, only subscribing to around 4 subscription plans at a price total aggregate price point of $61 a month. So if you want to be included in that bucket, you really need to stand out. And over time, these are things that could impact revenue. Top line growth has been especially important for Netflix. It really sort of operates as this growth company. So if you want to kind of maintain that status, you need to make sure that you're having double-digit revenue growth. So if you're seeing that revenue isn't being supported, if you're seeing that that trickles through potentially to advertising, where ad inventory per subscriber, that's all things that could potentially be concerning. So sort of a victim of its own success here.
94 billion hours streamed isn't a good number. That's
That's
eye-popping. Yeah, it's too good.
Netflix has set a bar that's just incredibly high. And that really is what it comes
When are
down to.
earnings?
October 17th.
October 17th. We'll see
there you go.
what they
Yeah,
say.
big
Looking
day.
forward to it. All right. Thank you, Alexandra Canal, for joining us. All right. Time now for What to Watch, sponsored by Tasty Trade. Starting off on the labor market, the monthly jobs report for September is coming out in the morning. Economists forecasting non-farm payrolls to increase compared to last month to 150,000, while unemployment rate holds steady at 4.2%. Hourly wage growth expected to slow to 0.3%.
Moving over to the Federal Reserve, we'll get fresh commentary tomorrow from New York Fed President John Williams. Investors will be listening for any clues about what the next rate cut could look like, especially after we will get tomorrow's jobs print. Atlanta Fed President Raphael Bostic telling Reuters earlier this week that he's open to another larger rate cut if the job market weakens further.
And be sure to tune in tomorrow as Constellation Brands CEO and President Bill Newlands will speak with Yahoo Finance's Brian Sozzi at 10:30 a.m. Eastern.
And we got a great 10 a.m. hour tomorrow. Also on Yahoo Finance, our very own Jennifer Schomburger will be talking to Chicago Fed President Austin Goolsbee. That's at 10 a.m. Eastern, and you won't want to miss it.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of this break, we've got Asking for a Trend, and I'll have you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Madison Mills. For the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to dive into for you. First, the future of AI in your wallet is happening right now. Intuit, the owner of TurboTax, has unveiled a new AI-driven expert platform aimed at helping consumers make smart money decisions year-round, not just during tax season. I'm speaking with the company's CFO in just a few moments. Plus, another housing hurdle for buyers and sellers as the decline in mortgage rates has stalled. So the question lingers, what was the market's enthusiasm on Fed rate cuts meaning, and was it perhaps a bit premature? We're going to break down the numbers later in the show. And the dock workers' strike at the East and Gulf Coast ports could give at least one sector a major hangover. I'll catch up with the president and CEO of Distilled Spirits Council about the impacts of the work stoppage and what that could mean for the beverage industry moving forward here. Well, Intuit is expanding into artificial intelligence. The financial tech company recently unveiling new AI-powered innovations, the goal to connect products in its consumer, financial, and business platforms. Here with more on AI connectivity, we've got Intuit's CFO, Sandeep Ajula, joining us now. Sandeep, it's great to have you. Thank you so much for making the time with us. So I know Intuit just had its investor day. I keyword searched the transcript from that day and saw over 100 mentions of AI, and then I just stopped counting. Figured that was kind of speaking for itself. But how are Intuit's new AI offerings contributing to the company's bottom line?
Hey, Madison, thank you so much for having me. We couldn't be more excited about the fact that we were early to invest in AI. We declared our strategy to be an AI-driven expert platform in 2018, when most were still trying to grasp the potential of AI. And by being early, by investing significantly into AI, and by leaning into building experiences, the done-for-you experiences using Intuit Assist, which is our Gen AI platform, we are making meaningful progress. We are making sure it is a durable advantage for us in terms of the experiences we could deliver to our nearly 100 million customers across the consumers and the small businesses we serve. And it really comes down to these customers rely on us to making the most critical decisions in their financial lives, whether it's their personal life or their business life. And by using Intuit Assist, and by leaning into using our AI-driven expert platform, we are making sure they walk away with the utmost confidence in the decision they're making, and is showing tangible impact on their bottom line and their top line growth as well.
So Sandeep, talk to me about how much revenue you think you're going to be able to attribute to AI moving forward. I mean, you're the CFO. I know you're constantly looking at that balance sheet. What are you expecting?
You know, what excites me about the potential for AI is how it's going to redefine customer experiences. And that leads to business upside from three primary avenues for us. First and foremost, Intuit Assist, Gen AI, in essence, is going to redefine how easy it's going to be onboarded into our platform and discover the offerings across a platform that can help a consumer or small business. That leads to increased higher customer growth and increased adoption of the platform, both a direct relationship to driving revenue growth. Secondly, the name of the game on a platform is getting the utmost confidence in decisions you need to make. And Intuit Assist provides a seamless unlock to AI-powered virtual experts that we have embedded throughout experiences. Mm-hmm. So that means a customer can quickly go from AI to engaging with a live human expert who has contextual awareness of the situation and deep expertise in the topic that customer is trying to make an investment. That itself provides an uplock into increased ARPC because those virtual experts come at a higher ARPC. And third, we are testing and we are learning about potentially launching done-for-you AI experiences, things such as our MailChimp offering, where we have the potential to manage the end-to-end marketing campaign for a customer, or in our money products, where we can help customers get paid faster. And we're seeing that through our early tests, customers are getting paid 45% faster when they use Intuit Assist to send invoices and invoice reminders. These are all areas where we are excited about the potential to have AI-generated or AI-specific SKUs, but the potential is meaningful across those three avenues that we are looking at to generate business upside from Intuit Assist.
And Sandeep, I want to end by just getting a sense of what you're seeing in terms of the health of small businesses. I know that Intuit has a lot of touch points with small businesses across the country. What can you tell us about the health of those businesses?
Madison, I am always in awe of the resilience and the courage of the small business owners, and we serve 10 million of them. So we have a very good picture across geographies, across the size of businesses and the industries that they serve. These small businesses continue to do well, but I would say that they are still not in clear skies, so to speak. Their revenue growth is up versus where it was pre-pandemic, but it's lower over the last quarter versus where it was at the start of the year. Their profitability is doing better than where it was pre-pandemic, but it's lower than where it was last year. And their hours worked are higher, but they're not looking for as much labor. It could be an indication of where the confidence is going forward. But here's what I feel good about. Our platform helps small businesses succeed. And when you look at the overall economy, 50% of businesses go out of business in the first 5 years. Those on our platform, their success rate is 19% higher. They are able to make smarter decisions. So by being on a platform, we are truly helping these small businesses navigate what remains a relatively uncertain macroeconomic environment and help them ensure that they are making the best decision to drive their top line growth and get the maximum on their bottom line in terms of their profitability. So it's an environment where it remains uncertain, but the Intuit platform is really helping distinguish success and accelerate the prosperity of those who are on the platform.
Sandeep Bajula, we got to leave it there, but really appreciate you joining us. Sandeep is the CFO at Intuit. Thanks so much.
Thank you, Madison.
Well, stocks closing the trading day lower as concerns over tensions in the Middle East, keeping investors cautious. Yahoo Finance's Alexandra Canal joining us now with the trading day's takeaways. Hey, Ali.
Hey, Maddie. Yeah, markets taking a bit of a breather, also in anticipation of that jobs report out tomorrow. But a few things that stood out to me as we really continue to track these market moves, one being utilities and the strength that we've just continued to see in this sector. We were a bit muted today, but for the past 7 days, every member in the utility sector has been trading above its 200-day moving average. We're about 20% ahead of those levels, which has only happened once before, back in October 2000. That was actually the height of the dot-com bubble. So this really speaks to the market breadth that we've been talking about, this rotation out of tech. Utilities has been seen as a defensive move, but also has benefited from the trickle-down effect from the artificial intelligence boom as well. And if we take a look at a sector map year to date, utilities is leading up about 30%. We talk a lot about tech. That's all the way over here, though. So utilities is almost double that. So certainly a sector to keep and watch, especially as we continue through the next half of the year.
Yeah, it certainly is, Ali, and there's no shortage of catalysts for the utility space. Obviously, it's a defensive play, but also the AI boom could be, contributing to its gains, and also some of the energy stocks and movement that we've seen over the course of today could also be a positive move up for utilities. But what else are you looking at for the day?
Another thing is oil. If you follow Martha Stewart on X, that is something that kind of circles around every time we see these huge jumps in oil. Now, this stemmed after we saw supply concerns be top of mind for investors when it comes to a possible retaliatory strike from Israel to Iran. And this is something that we continue to track when it comes to the Middle East and what could potentially happen with oil. You're seeing that today we were up more than 5%. Crude oil settling just below $74 a barrel. Brent, the international benchmark, that settled just below 78 a barrel, also up 5%. If we take a look at a 4-day, you'll see we're up 8% here, and it really sort of speaks to this volatility factor. Typically, when we see oil up, we see the major indexes down, which is the narrative that played out today. And since we're speaking about volatility, let's take a look at the VIX. We're trading around that 20 level. People are starting to pay more attention to that. We are off of the highs that we saw in mid-July due to the unwinding of the yen carry trade, that unexpected uptick in unemployment, but still something to keep in mind since geopolitical tensions often trickle through into the markets. And then, of course, you have that November election coming up as well.
You do. You've got a lot of stuff to monitor here, and it looks like we are seeing a little bit of downside protection from traders, especially as we head into that non-farm payrolls print tomorrow morning. So perhaps that's one of the reasons that we are seeing this lift on the VIX here. But Ali, what else do we need to know heading into that all-important day tomorrow morning?
Yes, the jobs report. All eyes are on this jobs report, and here's the expectations here. We're expecting non-farm payrolls to increase by 150,000. The unemployment rate expected to hold steady at 4.2%. Obviously, obviously what we see tomorrow is going to factor into Fed policy, whether or not we'll see that larger 50 basis point cut, perhaps a smaller 25 basis point cut. But economists have often looked at the jobs picture, and any deterioration or signs of that is a little bit spooky for investors because we could potentially be entering into a recession. But this is an interesting chart from Bank of America that caught my eye. We've seen the SOM rule be triggered. This is a recession indicator. It was triggered in July. However, it's never been triggered with claims this low. So this is initial jobless claims, the number of folks filing for unemployment. If we took a look back all the way to the early 1990s when this rule has been triggered, we are at this very low level. And I think this just speaks to the interesting job market that we're in, the interesting economy that we're in, and how a lot of these recession indicators might not hold true. And we could see ourselves in that Goldilocks scenario, which is obviously the goal. But tomorrow, depending on what we see, that could obviously play a factor into that.
All right, Allie, great chart here and great takeaways for the day. Really appreciate you bringing us all of that. Thank you so much. Stick around because we've got more Asking for a Trend still to come right here on Yahoo Finance. Mortgage rates rose slightly this week, mirroring a jump in Treasury yields, especially the 10-year yield, which serves as a benchmark for the 30-year fixed mortgage rate. So, what is causing the uptick here, and what does it mean for prospective home buyers? Joining us now to discuss, we've got Yahoo Finance's Claire Boston in studio. And Claire, it's great to speak with you. So, I mean, are we all the way back for the housing market? What's happening here?
You know, I don't think this is a great cause for panic if you are thinking about buying a home here. We saw Treasury yields move up a little bit this week, and mortgage rates pretty much track that exactly. And so what we're seeing at this juncture is basically just a little bit of reaction to what Jay Powell has been saying this week. He basically said, you know, we don't think we need to lower interest rates too fast, and so that's going to kind of put a cap on how much further mortgage rates can fall from here.
Yeah, and it certainly seems like we're seeing that play out, especially in the front end of the yield curve. But when you think about home buyers who are just wanting to know when the right time to get in is, I feel like I've certainly spoken with a lot of sources who have said the whole time, just do it now because it's just too hard to predict what the relationship of rates to prices is going to look like. What are your sources telling you?
Yeah, I'm hearing very similar things. It is probably a mistake to try to time the market because no one really knows where rates are going to go from here. You know, we could see mortgage rates go down a little bit further to end the year, but we were probably going to be kind of range bound in in this 6-ish% space. So, someone who's looking to buy a home, looking to refinance, if it makes sense for them, the time to act is probably now.
And real quick, any chance of prices starting to come in here?
It is tough. There's not a lot of inventory right now, and that is really, really putting a damper on housing affordability generally. So, we really need more supply, I think, before we're going to see home prices fall at all.
Yeah, and we're certainly hearing about increased supply and the challenges of that with both candidates running for office right now as well. So something that we will continue to monitor. Claire, thank you so much. Really appreciate you joining us on set here. Well, the dock workers strike at East and Gulf Coast ports could give at least one sector a major hangover. The distilled spirits industry and its consumers are already facing impacts from the work stoppage and could experience even more if it continues. The Distilled Spirits Council of the United States warning that the ports are vital to the industry, with 77% of U.S. distilled spirits exports and 43% of distilled spirits imports passing through those ports in the year 2023. Joining us now for more, we've got Chris Schwanger, Distilled Spirits Council President and CEO. Thank you so much for joining us here. So talk to me about what you're already seeing on the heels of this strike. Have you started to see any impact yet?
Hey, Madison, thank you. Yes, absolutely. First and foremost, let me just say, we don't like hangovers, and we just want everybody who enjoys beverage alcohol to do so in moderation and responsibly. But as the chart shows, 77% of U.S. distilled spirits exports go out of the 26 ports that are being impacted, and 43% of imports coming into the country. That is great Scotch, Irish whiskey, cognac, rum, vodka, gin, you name it, coming into the country. And even a day's strike was going to have a ripple effect in the supply chain and impacting our retailers and distributor partners and bartenders and all of the above. Now we're at the end of day 3. That impact's only going to get more significant as we go on.
So what's the potential pricing impact going to be? Are you already thinking about raising prices?
Well, we do know, look, I can't speak on behalf of our member companies, but we do know that suppliers and those that make the great distilled spirits products are now looking at alternative means of shipping. Air freight, obviously, is terrific, but it's more expensive. We're looking for alternative ways to get into different ports. What we're most alarmed about is we're leading into the holiday selling season. That is the most important time for our industry. If this strike continues, it'll almost without a doubt have a direct impact on consumers being able to buy their favorite distilled spirits brands as gifts and during the holiday spirit. So on behalf of the hospitality industry in the United States, we are alarmed and worried, and certainly call on all parties involved with this to try to find some common ground and get those ports reopened.
Yeah, Chris, we've seen the National Retail Federation pressuring the Biden administration to evoke the Taft-Hartley Act if things move further here. Is that something that you would also consider?
We support those efforts, obviously, and we know the Biden administration is resistant to that at this point. We just really hope and appreciate that, there's strong interest in all parties involved with this, and we certainly recognize and appreciate those hard workers that get the products off the ships and onto trucks to go out to American citizens around the country. We just really hope this gets resolved sooner rather than later, and whatever means necessary in terms of the government being involved, and certainly having a fair deal for everybody involved, so it doesn't have this significant impact on our great industry, but the American economy as well. It's a delicate situation. Our industry is very, very concerned about it. And even a week's strike could take 4 to 6 weeks to overcome the backlog. So we're really anxious, and we're hoping things get resolved soon.
All right, Chris, we got to leave it there, but really appreciate you making the time for us. Thank you so much.
Great. Thanks, Madison. Thanks.
Stick around. We've got much more Asking for Trends still to come. This is Yahoo Finance. For our chart of the day, we're looking at the rates of hires and quits among American workers. Yahoo Finance's Josh Schaefer joining me now with a closer look. Hey, Josh.
Hey, Maddie. Yes, what we're looking at right here is the quits rate, the number of workers that are quitting their jobs. This is from the Bureau of Labor Statistics JOLT survey, job turnover survey. And you can see here it came in at 1.9%. That's a cycle low going back toward the pandemic. And then you look really all the way across here, we're at about 2015 levels for quits. Now, quits is considered a sign of confidence among workers. I'm only going to quit my job if I feel confident I can get another one. So as quits come down, that means workers are a little bit more worried about what they're seeing in the labor market. We flip to our other line here. Well, that adds up. You're seeing the hiring rate coming down. So less companies are hiring, less people are getting hired. So that sort of corresponds with why quits are coming down. Now, the key question when we look at data like this is how concerning is it? And I posed that question to former Federal Reserve Bank of Atlanta President Dennis Lockhart earlier today. And I want to take a listen to what he had to say about jobs, quits, and hires.
The quits rate that we saw just after the pandemic in a very, very hot labor market was pretty extraordinary, and it reflected, I think, the view on the part of many people in the labor force that they could improve their situation by improve their salaries by quitting one job and seeking another one. And this labor market is much, much cooler than that, and that assumption doesn't hold any longer. So people are not quitting; they're trying to hold on to their jobs. We're not yet in a situation, and I hope we don't get there, of widespread firing of people, layoffs and such. We've seen just a slowing of hiring, and that feeds the quits rate as well.
So Dennis pointing out that really the concern here is where we might be headed. And Maddie, we spoke to another guest earlier today, Neil Dutta over at Renmac, and he pointed out, he said the trend is clear. He's talking about these lines coming down here. He noted that as those lines come down, as quits come down and hires come down, normally the unemployment rate is a lot higher than 4.2%. So that's his chief concern right now, is that things like this are pointing to what could be a higher unemployment rate, if not tomorrow's jobs report, maybe in the jobs report we get for October. And that's going to be a key trend to watch moving forward as we keep our eyes on that labor market.
Yeah, it absolutely will be, and certainly something that Neil is looking at as he calls for 100 basis points of cuts by year end. Josh, thanks so much for bringing us the chart. Appreciate it. Well, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night. Thanks so much.